is our second session. We did a similar session where we covered some other topics in February of 2025, which is available on the cawnetworkusa.com website. So I encourage you, in addition to listening and watching this recording, that you also look back and watch the webinar from last year. So I'm joined here today with my colleague, Peter Trieu, who is a tax principal in our San Francisco office. Both Peter and myself work in our private client tax services practice for BDO. A bit about BDO. BDO is the 5th largest accounting firm in the world. We're also proudly independently owned as an employee ownership program. And Peter and I have clients really all around the world. But because we're in the private client service group, we work very often with high net worth and ultra high net worth individuals, family offices, many of which have cross-border issues. And we're going to bring a lot of those client issues to life as part of the material that we're going to share today. You also see on the screen here that Jeff Aldridge, he is the Chicago chapter president for Chartered Accountants Worldwide, and he is not with us today, but he's our sponsor for our connection, BDO's connection with CAW, at least in Chicago. So our learning objectives for this session is to really describe some more of the common individual income tax issues that foreign nationals living and working in the United States may encounter. We're going to really go into more detail with respect to exit tax issues, as well as passive foreign investment company, otherwise known as PFIC issues. And then we're of course going to be talking about planning ideas around the various issues that we're going to be talking about today. Peter's going to take us through some U.S. gift, estate, and foreign trust issues, some of the more common concerns that come up, and also talk about planning items in regards to those areas as well. So our agenda is to start with a bit of a recap from a session that we did last February. Again, you can find that on the website. We also do Beyond Accounting bite-size podcasts that are available there as well, and available wherever you can find podcasts on Apple, Amazon, Spotify, etc. But we're going to just do a real high-level overview of that for purposes of this part 2 session. But like I said, the plan for this session is to get into a lot more detail with respect to passive foreign investment companies, as well as the U.S. expatriation tax, and get into a little more detail with respect to gift and estate tax planning and foreign trust as well for foreign nationals. We will be incorporating Q&A as we go through the session and making sure we capture that as part of the material as we present it. Okay, so with respect to what we covered a year ago in part 1 of this session, this first slide really represents kind of a high-level overview of many of the items that foreign nationals living and working in the United States, should be aware of. We really did part 1 kind of in the similar vein of like a tax orientation session if you were first arriving in the United States. And as you can see here, we started with providing an overview of what is a definition of a U.S. taxpayer. You can see the different sub-bullets there that we covered. We also addressed some of the more common double taxation mitigation techniques that foreign nationals will take advantage of. We did some discussion around U.S. income tax treaties. We then spent quite a bit of time talking about the required disclosures that any U.S. taxpayer has with respect to foreign accounts that they hold outside of the United States. This became much more aggressive back in when the Foreign Account Tax Compliance Act was introduced back in 2010. And so on the session last year, we go into more detail on each of these sessions, or each of the form numbers that you can see here in the required disclosures column. Then we spent some time high level talking about passive foreign investment companies, non-US entity ownership, And then because it is very often that foreign nationals will have rental properties outside of the US, we spend some time talking about those issues. With respect to kind of the second half of what we covered in the overview last year, we talked about non-US retirement and pension plans, some of the common issues that you need to watch out for there. We spent some time with departure year considerations. We did do a high-level overview of the US expatriation tax last year, but you'll see this year that we go into a lot more details on the US expatriation tax. One of the reasons why we selected that topic to go into more details this year is because it's come up quite a bit. We did receive a lot of questions after the session last year about it. And so we figured this is something that folks would like to know even more about. So this is why we're going to spend more time on that on this session. And then we spent some time talking about some outlook items from last year that have now materialized. Now that's a year later. The last bullet in that outlook column around gifts and bequests received from certain covered expatriates, we're going to be talking about that in more detail today as well. So with respect to really the first deep dive topic, it's going to be in the passive foreign investment companies topic, otherwise again known as PFICs. And so what we did on this slide is we really just provided an overview of what the conceptual framework is behind PFICs. And it really starts with the fact that this legislation was introduced a number of years ago, really building on the idea of denying US persons the value of deferral of US taxation on all passive investments channeled through foreign entities. Essentially, the idea is they want to prevent US persons from being able to own investments that are in a foreign corporation, so that those investments, the earnings, the gains related to those investments would realize current taxation and not benefit from deferrals because of the fact that they sit in the foreign corporation. So the way this is being accomplished is by introducing these rules, which result in current taxation on US investors that have these PFICs, changing the character in some cases of the underlying income from capital gains to ordinary income, and then also imposing various interest charges on the deferred distributions and gains of those investors. So those are the mechanisms why, how this is now being prevented. The central elements in taxations of PFICs are really, number one, defining what a PFIC is, establishing what tax regime will be imposed on the US owners of the PFIC investments, and establishing the reporting requirements. So we're going to talk about all of that in detail as we go here. First off is what is the legal determination of a PFIC? It's based on the fact that the underlying company is incorporated overseas. So it is only applicable to foreign corporations. The treatment of the foreign entity for local law purposes is not necessarily binding for US federal tax purposes. So by and large, if it's considered a foreign corporation from a US standpoint, then it could be considered a PFIC as a result. Foreign mutual funds are by far and away the most common PFICs that we come across. The other common PFICs that we come across are foreign hedge funds, as well as foreign private equity funds. But basically any foreign corporation could be considered a PFIC if it meets one of two tests, which we have here on our next page. So the two tests that we always look at to determine whether or not a foreign corp is considered a PFIC is the income test and the asset test. You can see here on the screen the description of each of those tests and definitions of each of those tests. For income tests, basically if 75% or more of the gross income of the corporation for the taxable year is passive, then we will have met the income test. Now, passive income, for purposes of this definition, you can see it there. It's any dividends, interest, gains from the sale of passive assets or rents and royalties, as long as the underlying passive income isn't derived in the active conduct of a trade or business, like in the instance that you're a trader of stock, for example, like a licensed trader that is, or perhaps like a trader of rental property, then that would be an exception to this rule. There are certain exclusions around active banking or insurance businesses, but outside of those exclusions, you meet that income test and you're going to be considered a PFIC, the foreign corp that is. would be considered a PFIC. The asset test, on the other hand, instead of looking at the underlying income, we're looking at the assets. So at 50% or more of those assets are held by the corporation that are producing passive income or held for the production of passive income, then it will have met the asset test. So if it meets either one of those tests, then it's going to be considered a PFIC. So once it's considered a PFIC, obviously the question is now what? So I referenced before that there's different tax regimes that will be applicable if it is considered a PFIC, and these are the tax regimes listed here in this second section here. So there's three. We got the default method, we have the qualified election fund method, otherwise known as QEF, and we have the mark-to-market election method. As you can see in the parentheses in those bottom two, the QEF method and the mark-to-market method are only available in the first year. So you can only make those elections in the first year. And the first year is defined as the year that you acquire the PFIC, or if you already held the PFIC prior to establishing residency in the US, it'll be the first year that you're a resident in the US will be considered that first year. And you have the option to make those two elections in that first year. If you do make these elections, they are binding, so they stay with the PFIC unless they're revoked. And it's pretty difficult to make the revocation. So you got to really make sure you're doing a deep and long analysis around whether or not you're going to be making these elections before you make them because of that difficulty in revoking. Now, that being said, I wanted to talk about the QEF election first. So the QEF election is basically an election that will treat the underlying PFIC not too dissimilar to what a US mutual fund would be treated. So that is an election that many individuals will seriously consider so that they can take a lot of the other complexities off the table with respect to how the underlying investment is going to be taxed from year to year. So if you do take the QEF election or make that election, then essentially any earnings within the fund, interest, dividends, capital gains, they're realized in the current year. So there's no deferral aspect. And then if you do generate a capital gain, then it maintains the nature of the underlying income. So if it's a long-term capital gain, you will continue to benefit from the long-term capital gains tax rates, which will be 15% or 20%, depending on your overall income. Otherwise, it would be treated as ordinary income, which can be taxable at the top rates, which is currently 37%. So that's the big advantage of the QEF election. Mark-to-market, I'll talk about that one next. So mark-to-market is just what the name suggests. The way income is being recognized is by taking the value of your investment in the PFIC, comparing it to the value in the preceding taxable year, and to the extent there's an increase, then you're going to be recognizing that increase as ordinary income, and then to the extent there's a decrease, you'll be recognizing that loss as an ordinary loss. We don't see this type of election made as frequently. Obviously, it's going to depend on the nature of the underlying investments that you have within the fund. But if you do make that election, that is the mechanism by which the underlying income will be taxed. And again, I said ordinary, I said, not capital. So if you make the mark-to-market election, then you're going to be treated, the underlying income will be treated as ordinary, meaning it'll be taxable at the, possibly the highest rates, 37%. So if you don't make either of those elections, or if you miss making an election because you realize you have a PFIC after the first year that you had the PFIC and you're required to report it, then you're going to automatically be subject to the default method. And so the default method is the most punitive, as you can probably expect. So the way the default method works is similar to mark-to-market, but it takes off the table any type of preferential tax rates. Anything that you're going to be subject to tax under the default method is going to be subject to the ordinary rates, tops at 37%. But the way taxation gets triggered under the default method is strictly based on distributions. So if there is no distribution and you hold a PFIC and you're under the default method, then there will be no taxation. But if there is a distribution, then we look at that distribution, we compare it to distributions for the preceding 3 taxable years. And if the distribution in the current year exceeds 125% of the average of the 3 preceding taxable years, then you have what's known as an excess distribution. And that excess distribution is going to be subject to tax at ordinary rates. But in addition to that, it'll be subject to a compounding interest charge as well. The compounding interest charge is assessed on the tax of that excess distribution. But because you had that charge in addition to the top rate, which you could be 37%, then you can have instances when you're under the default method where the total tax rate could be in excess of 40 or 50%. So if you're getting a distribution from a PFIC under the default method, it can get really complicated really quickly, and the tax rates can be quite high. So this is another big reason why, if you haven't taken a distribution, then you really want to think twice before you do it, do planning. And then honestly speaking, like if you do not plan on being in the US for longer term, and you have the ability to not take a distribution while you're a resident of the US, that's another planning mechanism, because once you leave the US, your residency ends, assuming you're not a green card holder. Then if you take a distribution after you're no longer a US resident, then you're no longer be subject to this. So that's another kind of planning technique. The other planning technique, which is not going to work, but it comes up as an idea, is okay, if I just take my underlying securities that I have within the PFIC and I just donate them to a charity or a donor advised fund, or if I gift them. Unfortunately, a distribution is considered whether it's a distribution to yourself or a distribution to another party. So you'd still be subject to all the tax rules that I just described, even if you're donating the underlying security to a charity or gifting it. So that isn't unfortunately a workaround that you can deploy here. All right, so moving on. So with respect to the disclosure requirements, if you have a PFIC, the disclosure is made on Form 8621, as you can see there. The general rule is that you're always going to have this reporting requirement if you have a PFIC. It doesn't matter what method of taxation that you're electing, whether it's default, QEF, or mark-to-market, you're going to have this 8621 reporting requirement. And there are, of course, with everything in tax, exceptions. The exceptions in this regard for 8621s and PFICs is if the value of your aggregate holdings, so this is not just a single PFIC, but all your PFICs, if your aggregate value that you hold in PFICs is less than $25,000 if you're single, or $50,000 if you're married filing joint, then you would meet an exception where you don't have to file this 8621. But that's only if there is no distribution from the PFIC or gain within the PFIC. Otherwise, there would be, even if you're below those thresholds. The other exception that comes up is if you have a PFIC that is in a non-US retirement plan that is also recognized under the US and non-US country double taxation treaty. Many folks that are part of the CAW network, have a UK SIPs, for example. So if you do have a PFIC within a UK SIP, more likely than not, you're not going to have this 8621 obligation. If you hold it in a regular brokerage account, or even if you hold it in an ISA, there could still be this PFIC obligation. So if you have an ISA, I just recommend that you work with an advisor to really review that to see if in fact you're going to be subject to the PFIC obligation if you're below those thresholds. So that's the other, or above those thresholds rather. That's the other exception that we wanted to toss to. Now, of course, with any type of form or disclosure, if it isn't filed with the IRS, then there's going to be penalties for failure to file, and there's no exception to that with respect to this Form 8621 requirement as well. There will also be underpayment penalties if the 8621 is not filed timely. And then perhaps most punitively is the indefinite extension of statute of limitations. So if the 8621 is not included in your Form 1040, then that 1040 could be selected for audit at any time, no matter if the statute of limitations have expired or not. So that's another big reason why we always want to make sure that if there is an 8621 obligation, that is filed appropriately, even if it's late. So with respect to some of the more kind of practical examples here, we wanted to show one of those on the left-hand side. So what you're seeing on the left-hand side here is what's called a PFIC annual information statement. And so these type of statements are very often provided by the foreign corporation to their US shareholders. If it's a larger non-US mutual fund that has many US shareholders, then having this type of statement be made available to you is quite common. And that's why we've shown you an example of that here. If you also have a US shareholder that has made the QEF election, then this is actually technically a requirement for the foreign corporation to provide this to the shareholder that has made that election. That being said, if it isn't like, a larger mutual fund, for example, that has many US shareholders, then the only way you can make a QEF election then is if you have access to the underlying books and records of that foreign corp, which honestly is really going to be only realistic if you're a material shareholder in that foreign corp. Otherwise, if you don't have access to it, then technically you can't even take the QEF election in the first place. So I just wanted to point that out. On the right-hand side, we have what the Form 8621 looks like. This is just the first page. And, like I said earlier, no matter what election method you choose, it's going to be the same form. The one thing that I just want to make reference to as well, just respect to what we see a lot with our clients, is if they hold a PFIC indirectly because they are a partner or shareholder in a US partnership or US S Corp, for example. In those instances, many times the US domestic partnership or the US domestic corporation will have made the QEF election on behalf of all of the partners or all of the shareholders at the partnership or corporation level. And if that's the case, then you as an individual shareholder under 1040 won't have to file the 8621. Instead, that 8621 will have been filed at the partnership or the S Corp level. So that's just something that I always want to point out. And if that is the case, typically that's going to be disclosed as a footnote on your K1 for the partnership or the S Corp, so that you'll know whether or not that you have to do the 8621 disclosure on your personal 1040, or if it's already been handled at the partnership or S Corp level. All right, so that's quite a bit on the PFIC topic. So we're going to move on here to our next topic. All right, so our next topic here is the US tax consequences of expatriation. So like was mentioned earlier, this topic comes up more and more often nowadays. So we wanted to provide a deeper dive into this topic for your benefit. So we're going to start here just with a bit of the history of the US expatriation tax rules. So these rules have been in place since 1966, as you can see here. From 1966 to 1996, it was only applicable to US citizens that wanted to relinquish their US citizenship. But with the advent of the green card and a lot more folks having the green card, in 1996, it was expanded to also include green card holders, but only green card holders that are considered long-term residents, which my colleague Peter will talk about more in a minute here. In 2008, the HART Act was enacted, and this made the expatriation tax much more extensive because it introduced this mark-to-market exit tax to the expatriation tax, meaning basically all of your assets, we're looking at the value upon the expatriation date, and there's a mark-to-market. Peter's going to talk about this in more detail in a bit, but in 2008, this was a big deal because this was a major change in this regard. Only covered expatriates are going to be subject to this expatriation tax. If you're to be considered a covered expatriate, you have to meet one of these three tests that are listed below. You can see we have the tax liability test, the net worth test, and the certification test. The tax liability test is just what it suggests. It's looking at your tax liability on your personal tax return, and if it exceeds the average of, for 2026, the amount is $211,000. If it exceeds that for the preceding 5 taxable years ending before the expatriation date, then you will have met the tax liability test. The net worth test, instead of looking at tax liability, is looking at your net worth. And as you can see there, it's a $2 million threshold for net worth. And that's $2 million per person. So if it's a married couple, then you're looking at $2 million each. And that isn't adjusted for inflation. So it's been $2 million for quite some time. So that's much easier nowadays to exceed that than it was before. The certification test is the last test that we look at, and essentially there is where if you haven't certified under penalty of perjury that you've complied with all of your U.S. federal tax obligations for the 5 preceding taxable years prior to your expatriation date, then you essentially will have met the certification test, and therefore you'd be considered a covered expatriate under that test. So I'm going to flip it over to my colleague Peter here to take us through the rest of expatriation tax and as well as the next topic. So Peter, over to you.
Thank you, Dave. So as Dave was mentioning, the expatriation tax applies to covered expatriates, and those are the expatriates that meet those 3 tests. Now, before you get to those tests, however, we need to determine who the exit tax applies to. U.S. citizens who relinquish their green card, relinquish their citizenship, as well as long-term green card holders. Now, a long-term green card holder is someone who's been issued a green card and has held that green card for any part of more than 7 years. So, for example, if your green card was issued on 12/31/2026, then 26 is your first year with that green card. And so if we count all those years and we exceed 7, we're already in year 8, then we're a long-term green card holder. And so if we relinquish our green card post the 7 years, then we need to run through those tests to determine if we are a covered expatriate. And if so, then one, exit taxes apply, where we essentially have a deemed realization event. And so all of the unrealized gain in assets held the day before expatriation is deemed to have been sold, and so we calculate the gain associated with it and apply the tax. In addition to any mark-to-market deemed realization event, if the covered expatriate has an interest in a non-grantor trust at the date of expatriation, there's no mark-to-market in the trust assets. However, future distributions from that trust will be taxed at 30%. Even though the person is no longer resident of the U.S., they're still subject to that 30% tax on the gross distribution. The other tax that's applicable to covered expatriates in a way is somewhat of an inheritance tax. Normally, a U.S. person receiving gifts, bequests from anyone, it's not subject to taxes. However, when a U.S. person receives a bequest or gift from a covered expatriate, now that person must pay taxes at 40% of the fair market value of those assets that are being received from the covered expatriate. So it's very important that even if exit taxes may not be applicable, if covered expatriate status can be avoided, that's the way to go. From a planning perspective, if we can, to avoid covered expatriate status, or at least to minimize exit taxes, there are a couple of ways to go about doing that. One is if they have a primary residence, before the exit, sell the primary residence as being a primary resident. We can exclude up to $250,000 from a gain from taxes, or if we're married, we can exclude up to $500,000. That's a very effective way to eliminate all of these appreciation in the estate free of taxes. The other way, very common, is to make gifts. As a U.S. estate and gift tax resident, you're able to use the lifetime exemption of $15 million, in addition to the item exclusion, $19,000 currently, to make gifts to whomever, completely free of gift taxes, so long as we're shielded by the exemption amount. And then if we're down below the $2 million threshold, and assuming the income tax liability is also met, then we can expatriate with no exit taxes whatsoever. And if we're below the $2 million threshold, then we won't even have covered expatriate status. So future gifts back to U.S. persons, not subject to taxes. It's a very, very effective way to avoid covered expatriate status by reducing the net worth of the expatriate to below the threshold. If we're in a situation where we have a married couple and only one spouse is expatriating, then they can gift an unlimited amount to the U.S. citizen spouse who remains a U.S. citizen. And so that way we can very effectively get to the estate below the $2 million threshold. So that's the expatriation tax regime. Next will be the estate and gift tax. So with regard to the estate taxes, they're applicable on a worldwide basis to U.S. citizens as well as U.S. residents. For non-residents of the U.S., it's still applicable, but only to U.S. cited assets. So what's a U.S. person? Clearly U.S. citizen. In addition, we have a U.S. resident. So the definition of U.S. resident for estate and gift tax purposes is different from the definition of resident for income tax purposes. For income tax purposes, we have a very bright line test. We're either substantially present or we have a green card. And if we have either, then we're a U.S. income tax resident. For estate and gift tax purposes, we're a U.S. resident only if we're domiciled in the U.S. And being domiciled in the U.S. is a facts and circumstances test, somewhat subjective in that we need physical presence and we need the intent to make the U.S. our permanent home, which is clearly a subjective test as to does the person have that intent. How do we determine intent? We look at various factors. The largest ones are location of home, family, and business, social and business ties. Certainly having a green card or long-term actual physical presence in the U.S. are factors, but they are in and of itself not determinative of domicile. If we're considered domiciled in the U.S., then like U.S. citizens, we're entitled to the annual exclusion. We're also entitled to the lifetime estate gift tax exemption, which is currently $15 million. So with the $15 million exemption, we can make gifts during life, and we can leave bequests at death. And in either instance, if we're below the $15 million in total from gifts during life and at death, below $15 million, there's no estate gift taxes applicable. If we're in excess, then we're looking at 40% taxes on whatever we have in excess. Again, for non-residents, the estate gift tax still applies, but only to U.S. cited assets. And if we're non-resident, we don't get the $15 million estate exemption. We only get a $60,000 exemption. We're still entitled to the $19,000 annual exclusion, but that's it as far as gifts. There's no gift tax exemption that's allowed to U.S. residents. The advantage, though, for non-residents is that they're only subject to estate gift taxes on U.S. cited assets, which is, for example, includes U.S. real property. The other major asset is U.S. stocks in U.S. companies, which has a duality of treatment. For gift tax purposes, a stock is an intangible asset, and so non-residents can gift stock in U.S. companies completely free of gift taxes, and there's no reporting, no taxes associated with it. If instead that non-resident dies holding the stock in the U.S. company, now that stock is subject to estate taxes. So very important that if we have a non-resident with U.S. stocks, that either A, they convert it to a non-U.S. asset by contributing it to a non-U.S. company, for example, or gifting those stocks away before death. So related to the estate gift tax are foreign trusts, which can be a very complex area where a lot of traps can be set. are set for U.S. beneficiaries of non-foreign trusts, in addition to potential U.S. residents who are settling these foreign trusts, either before or after becoming U.S. persons. For example, before we get to what a foreign trust, we want to define what a foreign trust is. A foreign trust is either A, we have a non-US person who's a power holder in the trust. That means a trustee, a protector, anyone with a substantial power over the trust. That would make it a foreign trust. The other type of trust that makes it foreign is that it's simply settled under a foreign law, non-US law, where a non-US court has jurisdiction over that trust. And so if we have either a control test, a foreign person controlling some substantive power over the trust, or we have a foreign court that can exercise jurisdiction over that trust, in either instance, we have a foreign trust. And after we determine if we have a foreign trust, we now need to determine, is it a foreign grantor trust or a foreign non-grantor trust? With foreign grantor trusts, they tend to be most advantageous from a U.S. tax point of view if the settlor of that foreign grantor trust is a non-U.S. person. A grantor trust is taxed in a way that is essentially invisible. We have the settlor consider the grantor of the trust, and if they are a non-U.S. person, then though they're taxed on all of the trust income, if the trust income is all non-U.S. source income, then there's no U.S. taxes associated with it. So when we have a U.S. person who receives a distribution from the foreign grantor trust, no taxes to the U.S. person because the tax is deemed to have already been paid by the grantor. So all gifts from a foreign grantor trust completely free of taxes to the U.S. beneficiary. If we have a foreign non-grantor trust, the trust itself is a taxable entity. So all the trust income not taxable to the settlor. And so therefore, we have a distribution from a foreign non-grantor trust to now those U.S. persons are subject to tax. If the U.S. persons receive distributions of income generated in the current year, then that according to the character of the income, whether it's capital gains or dividends or interest. If instead the U.S. beneficiary is receiving income that's accumulated in the trust that was generated in prior years, now the U.S. beneficiary is subject to what is known as throwback taxes, which is a rather complex calculation of taxes determined upon the income created at the inception, taxed in that particular year, and then interest added upon that. And then we have a distribution to the U.S. person, all subject to taxes way back to when the income was generated. The throwback tax is rather punishing regime. So it's a good idea to plan around that, either A, to eliminate any of income in the trust, or somehow maintain foreign grantor trust status so we don't have issues of creating accumulated income in a foreign non-grantor trust. With foreign grantor trusts, again, as to the establishment by the settlors. With a foreign settlor, if we can have the trust either A, revocable, or limit the distributions during life to either the settlor and or the settler spouse, then we have a foreign grantor trust. If we don't have either of those, revocability or benefiting only the settler spouse, then by definition, we have a foreign non-grantor trust. When we have a foreign trust that's created by a U.S. person, then we can create even more U.S. issues. A U.S. person who transfers assets to a foreign trust with U.S. beneficiaries, that's still treated as a foreign grantor trust, but now it's as to a U.S. person. So all of the trust income taxable to that U.S. person. Rather straightforward, as if the settlor retained all the assets. The issue then becomes, though, when the U.S. person dies, we have a foreign grantor trust that now automatically converts to a foreign non-grantor trust. And when you have a U.S. person transferring assets to a foreign non-grantor trust, that's a deemed realization event, where all of the unappreciated gain in trust assets is all taxed as in a deemed sale, where we're paying a capital gains tax on all of the gain within the trust. And this is an area where we have a very hidden trap, as it were. If you have a non-US person settling a foreign trust, and then they become US residents, within 5 years of settling that trust, they are now considered to have settled that trust as a US person on the first day of US residency. So if it has US beneficiaries, then it's just a foreign grantor trust going forward. If it has no US beneficiaries, then upon the first day of residency, we have a US person having transferred assets to a foreign non-grantor trust, and we have that derealization event. The other problem here is that if we have the settlor become a US person and the trust has US beneficiaries, again, we have that foreign grantor trust as to that US person. When that settlor, though, ceases their US status, for example, they're temporarily here in the US, when they leave, again, we have a foreign grantor trust as to US person, which is now converting to a foreign non-grantor trust where we don't have any tax to a US person anymore. So then again, we have that derealization event. So if you have a non-US person settle the trust, comes to the US temporarily, and then upon leaving, we have that derealization event, which can be a complete surprise to any non-US persons who settle their trust, and then they come to the US and they realize that the two are still connected regardless of having settled the trust in the past. And the last thing about foreign trust is potential reporting. If you're a US person, you receive distributions from a foreign trust, you need to file a Form 3520 to report that you receive these distributions. If you are a US grantor of the foreign trust, you're also filing a 3520A in addition to indicate that you are the owner of the trust assets. If you're a US beneficiary of these foreign non-grantor trusts and you have a financial interest in the trust that is large enough to exceed the threshold for certain foreign filings like the FBAR or an Indiana 38 or 5471, for example, then those filings also need to be made regardless of actual ownership in any of the trust assets. And that's the quick summary on state gift tax and foreign trusts. So I'll turn it back over to Dave.
Thanks, Peter. So we've covered our question and answers as part of the material that we covered today. So just going to recap. Thank you so much for watching this webinar, this replay. Again, if you have any questions whatsoever, feel free to reach out to one of us. We provided the contact information, as you saw, for us in the beginning of the slideshow. And, we would be happy to connect with you in more detail. So thank you so much and have a terrific day.